right now we are going to be talking about straddles. Straddles are combining two separate call options. That's one call option and one put option. And they will have the exact same strike price and expiration.
And you actually go and physically, in mine on E-Trade, you
Yep.
actually hit straddle, correct? It creates
Correct.
it. You don't have to go and buy them individually.
That's correct. You can do the
Okay.
same thing. Yeah, you can do the same thing in Weeble too, by the way. So this would be a perfect example. Wow, you guys want to see me do a straddle in real life?
Yeah,
Real
that's what. Yeah,
time?
it'd be great.
Yep. I'm going to change it to a straddle. I'm going to go closest to right here. Let's see if it'll scoop this up. We'll just do one.
And you hit straddle, correct? Like,
Yes.
Okay.
Now, I don't know if it's going to pick up both. I'm about to find out.
Oh, that's it. Yeah, that's, I guess, a good point. That
Yep. Let me
doesn't
look.
necessarily pick up.
See, because all it bought was the call. So,
Hmm.
which is funny. So this is not working. So you have to buy one call and buy one put that are going to be the same. So right here, I'm going to buy one call, or I'm sorry, one put.
Mhm.
Remember, this is the 403, buying it here, place order. Okay. And then I'm going to do the same thing and I'm going to buy a call, the exact same strike price, the exact same expiration. I missed it. Try to buy it again.
And that's the same. That's just mechanically wise. That's obviously a lot more laborious than just hitting the straddle. But you
Yeah,
had to do that.
exactly. And yeah, exactly. And they must just not have that working yet. But
Okay.
in theory, you're supposed to be able to go here, change it from a single to a straddle, click buy, should scoop them both up, and you're done. And I'll have to mess with that or message them and see. So what this does, by the way, is now I've got one set for one way and one set for the other. If you guys actually look down here, this is a real live example of it. So right here is the call, okay, and right here is the put. So now I have one of each right here.
So you buy both, not buy one and sell one?
That's correct. I'm in one for each side, right? So depending on which one everyone takes off, I'll make more money, right? Now, here was the thing. Calls typically cost less than puts, all right? So your puts will typically cost you more money than your calls will. And do we all know why that is? Remember, puts, we make money if it goes sideways or down, right? That's a put. Calls only make money when they go up, all right? So that's why your puts will typically cost you more money. So when we go into a Fed meeting or earnings or whatever, you can scoop one of these up. And what the idea behind it is you want one of them to basically overwrite the other one's loss, right? Because you have to take a loss on one way or the other.
On one of them, right?
Yeah, on one way or the other, right?
Right.
My call, you want to eventually pay for the put, or I want my put to eventually pay for the call and then keep running, right?
Mm-hmm.
So that's how you make your money, is one of them will overwrite the other one and keep going. Now, the advantage of doing it during the work, during the regular trading day, is I could put stops in here, okay? So if you look at my screen right now, let's say I'm in a call here and I'm in a put here, right? And then I have a stop here, both for each side, and a stop here, both for each side. What this does is it goes, hey, this is a call, and it just keeps going. And now I want to trigger to get rid of the call because the put is printing, right?
Right.
So that way it gets rid of one and lets the other one continue to run, right?
Okay.
Because the other methodology behind this is you have to literally let it keep running its entire course until it eats up the opposite direction, and then your put becomes profitable because it paid for the call and it's continuing to run, which means I made more money on it. Now, where this becomes dangerous.
Yeah.
If it sits in the middle of these, right, and this goes flat on me, well, I don't make any money either way. I just end up losing money. My put's not printing, my call's not printing, and I've paid all this premium, and now I'm running out of time, which is time decay, right? So now I'm just running out of time, and every day I'm holding on to these, right? If this is a day thing, not just, I'm holding overnight instead of just during the day as a scalp, because we're talking about earnings, which means you hold overnight. Well, now I'm losing money both ways because both of these are losing every single day I'm holding them. So now every day I wake up, and I'm losing. Let's say I bought SPY till Friday because we have earnings on Wednesday. Well, that means every day I lose 10 to 15% of both of them every day I wake up, right? So every day I wake up, they're both losing me 10 to 15%. Does that make sense? Because of time decay.
Right.
So it's like, well, damn, now they have to work that much harder again, just like holding either one to make money. So time decay will continue to wreck them. So that's no good. We don't like that, right? And we have to make sure that one is overriding the other. Here's the other thing where you can run into a problem. So I had my call here and I had my put here, just like we have. You guys can see it in real time right now. Here's the other problem. What if this pulled down and I had my stop loss? So right here told me to get rid of my call, right? Because it was like, hey, this looks like it's in a put. I get rid of the call. Well, look what it did. It see the directional change?
Hits it and bounces.
Yeah, now I'm in a put,
Right.
and it's
And
going
you're really
the wrong
screwed.
way.
Right.
Yeah.
I see.
So now I'm like, well, damn it.
Right.
You're like,
Now
well,
you got rid of the call, and now you're in. Right.
yeah, now you're like, well, now I just got ran over both ways. So
Okay.
the other thing is what you want is you need this to be very clear and concise, ginormous moves.
Right.
For
So
this.
that's why, and that's why my question was for you is that in anticipation of some of these earnings or Fed talk here coming up with this volume and velocity one way or the other.
Yep.
Would be a good, and had I done this with my last Fed talk,
yes, you wouldn't have gotten hurt like that, right?
Right. But and mechanically, everybody I think should go and practice this in paper trading to be able to mechanically go do it fast. The other question I have real quick is that if so don't do these overnight, and optimal opportunity here would be to do it like a 1:30 Fed talk or midday Fed talk or midday.
Correct. It's much easier to gauge because you can do it. But remember, here's what's rough with Fed talk, right? They're worse than earnings, because if you guys remember, we can have bad news with a Fed talk and it goes like this and then it goes like this, right? And you're like, wait a minute, that's because the market doesn't know what to do with it yet.
Yeah, but can't you sell out of both of them at the same time and come in real quick?
Yeah, you can.
That would be the best way to do it, right?
You can. You just have to. Well, here's the thing, though, right? If this one blasted up, right, it doesn't necessarily mean that you've made more on this call than you lost on the put, right?
Oh shit! Yeah.
So you could have you could have did nothing, right?
You got a lot of quick thinking on your feet.
Yeah. Oh yeah. It's like, holy crap. So the best way, obviously, is like, boom, it's riding up. Okay, awesome. You sell the call, and then boom, it's going back down, and now you get to, you let your put rider sell it. So yep.
So sell me on the opportunity here. Where's the upside? I see the downside and the risk.
Well, the upside is that here's the upside is, first of all, because you're in both directions, you're in the play, right? So if this was a hold overnight, this is like earnings. You hold overnight, you wake up, the bell hasn't rang yet, and it's taken off one way or the other. The advantage is, if it's good news, we pretty much know what the overall trend is going to be. We also know if it's bad news, we know what the overall trend is going to be, right? Which means typically that means we can get rid of one or the other and then let it continuously run, but we're in the play.
Right.
So
yeah, that was to my point from this last week of riding some of these overnight. I know we don't sell that theory long term, but it's worked out fairly good for me because I felt like I was missing out on some of these Teslas running in the middle of the night, $7, and it's like, damn, I need to get in some of
the best thing to do with it, Jimmy, and for everybody else too, is literally, don't do this with 1,000 contracts. Do this with one. Test it out. What's the theory look like? How did it actually work? Jimmy, you have the advantage because you can do what's called at the money, right? Meaning one bracket up or one bracket down. It'll cost you a little bit more, but you can see the real science behind it to know, because other people might be doing really far out of the money and then it barely moves because your delta's so far away. You know what I mean?
Right.
You will get to be able to take advantage because to you, it's okay to pay the $200 training fee, right? To go, what does it look like the next day on a real call or in a real put? So I would do one, like you could do one up.
Well, I was just going to do it on Lucid just today, just to test it out. I felt like Lucid at $12 here it's going to go north or south here pretty quick.
Yeah, and then exactly. And then you could determine what it does by how much it pulls, just like this. So I'm in one and the other, but the cool thing is if SPY keeps pulling, my puts are going to continue to print, and then I'm going to go, you know what? It's staying below this 402.17, which we marked as a good range. Well, now it's 401.93, right? It stays down there. I'm like, well, I can get rid of the call because now most likely today it's a put. So
it's a nice little insurance policy.
It is. And if we really wanted to get crazy, this is what it will look like. So here's my call, here's my put. So here's what I would do. I go in here and then I would put a stop on both directions. So my put, I paid $1.38 and it's now at $1.48. I could say, okay, put in my stop. I'm covered on my put if it goes the wrong way. And now I'm going to be covered on my call if this goes the wrong way, right?
Mhm.
Which I would have done, by the way, as soon as I got them because, you know, you want them to work that way. Let's see. A call paid 55. It's at 50. So same thing. Oops. And there it went. And then I let it go.
Right.
Is there a way to take profit? Because what I'm thinking is that during Fed talks and this kind of talks,
Yeah.
I mean, it moves so fast.
Yeah. It could run up and run down real quick.
So
Now,
you just
could.
so you just say, well, you know, I'll tell you what, if it goes this far, I just want to take the profit.
Sell them
You
both at
could.
market quick.
Yeah.
Yeah.
Well, just set it up to just take the profit.
Absolutely. You could do that. So here's what you would do at the time of purchase. Okay. So right here, let's say, and I do this sometimes when I'm scalping. I don't do it very often, but right now it's showing a call. Hold on and we'll see what this trade looks like. This looks like a call, right? Watch this. I go here, I go to my single contract and I have to go, oh, now it's a put. All right, let's do a put. Here's 10. I can literally tell this take profit. Do you see this? And then I can just tell it what percent. So right here, I'm saying 10 by mid, right? We want the mid price right here. I can say I want to take my profit. I usually do a percent. I'll do, hey, if you move whatever the percentage range is, you see this? See how it says estimated profit?
Yeah.
Put in whatever you want it to be. There it goes. So this would be a 50. Yeah. Okay. Normally I do like, I want to say it's 0.25%. And that typically, because I'm usually doing 50 or 100 contracts, but that's typically around 50 or $100, right? And that way, as soon as it moves, you collect the money and you're in and you're out.
Well, good. Okay.
Yep.
Well, thank you. Hopefully that helped out other people as well.
Absolutely. So just experiment with it. See what you can do.